One question I asked the panel is, are you preparing for a long war? And the thing that really struck me is everyone basically said yes. They said, we've been preparing for a long war since day one. And that's our job. That's kind of our job to be pessimistic. But you really do see in the actions that they are preparing for prolonged disruption. That scenario of the long war, to me, and from talking to people here this week, feels like the mood in the room is that we are in for a long war and certainly for a protracted disruption.
Welcome to Smarter Markets, a weekly podcast featuring the icons and entrepreneurs of technology, commodities, and finance, ranting on the inadequacies of our systems and riffing on ideas for how to solve them. Together, we examine the questions: are we facing a crisis of information or a crisis of trust? And will building smarter markets be the antidote? This episode is brought to you in part by Abax Exchange, bringing better price discovery and risk management tools to navigate today's commodities markets through centrally cleared, physically deliverable futures contracts in energy, environmental, battery materials, and precious metals markets. Smarter markets are here.
Welcome to Scenes from the FT Commodities Global Summit in Lausanne, 2026. I'm Dave Greeley, Chief Economist at Abax Technologies. Smarter Markets returned to Lausanne, Switzerland last week for the 15th edition of the Financial Times Commodities Global Summit, where we caught up with summit participants on the important issues of the day. The theme for this year's summit was Finding the Advantage in a Fragmented World, and the conversations were focused on the state of our supply chains and the increasing stakes of the ongoing conflict in Iran. We've compiled a selection of 7 of those interviews into this special episode of Smarter Markets. If you would like to listen to the full interviews, they're available on our website, smartermarkets.media, on the SmarterMarkets Presents media page. They're also available on our second podcast channel, SmarterMarkets Presents, available on all major podcast platforms. Our guests in order of appearance in this episode are Leslie Hook, Natural Resources Editor at the Financial Times; Halima Croft, Managing Director and the Head of Global Commodity Strategy and MENA Research at RBC Capital Markets; Robert Friedland, Executive Co-Chairman at Ivanhoe Mines and Co-Founder, Chairman, and CEO of iPulse; Brian Manel, CEO and Chairman at TechMet; Gracelyn Bhaskaran, Founding Director, the Critical Mineral Security Program at the Center for Strategic and International Studies; Ruth Kroll, CEO of the London Bullion Market Association; and Alistair Weir, Head of Environmental Markets at Abax Exchange. We hope you enjoyed these scenes from the FT Commodities Global Summit in Lausanne, 2026. Leslie Hook, Natural Resources Editor at the Financial Times. Thanks for joining us. We've had such a great week here at the FT Global Commodity Summit, like we always do. The theme this year was Finding Advantage in a Fragmented World. And there were some interesting changes on the agenda this year. A lot more metals, a lot less carbon. And I was just kind of curious, when you're putting together the agenda, and of course you have an event like Iran happen right in the run-up to it, what were you looking to kind of capture in the conference this year?
Yeah, well, no one saw the war in Iran coming, certainly not us. And that was the big theme that really dominated every single panel on stage, understandably. When we were putting the agenda together about 8 months ago, one observation is that a lot of the trading houses last year were diversifying into metals and diversifying out of energy markets, in some cases reinvesting the windfall energy profits they made in 2022, 2023 into other commodities. So we've seen gold desks at a couple of trading houses and big push into metals, including from Mercuria, which is, I think they said they've done $3 billion in prepayments now for their metals work. So we've kind of seen a bit of a broadening of the way these large houses think about themselves. And some of them have always been in metals, like Mercuria has always been in metals, Glencore has always been in mining as well as metals, but that felt like a shift.
And it felt a lot more conversation around the physical this year as opposed to the financial, with supply chain probably being one of the most used phrases at the conference. How does that enter into the coverage you have the rest of the year? What you're able to kind of learn about how the commodity trading houses are thinking about it here?
Well, that is a really interesting observation because we have seen this huge disconnect between Brent crude futures prices and the physical market. And it does feel like in the last 8 weeks or so since the war began, even our own coverage and what I'm talking about with my colleagues is much more focused on these physical markets, the regional premiums, dated Brent for physical delivery in the North Sea. So in a war like this disruption is physical, and that's kind of where the story is. And for the trading houses, that's where the work is. And I think this disconnect with the futures market is really interesting. And actually, I'd be curious to hear your thoughts on that too, because it does feel like the financial market is kind of voting in a very different direction than the physical traders. And certainly, I've had a lot of people say to me here, they just feel like that Brent crude prices are really not pricing in what they're seeing on the ground.
And you wrapped up the day today and the conference with the CFO panel, which is one of the perennial favorites of the conference. I think everyone likes to try to figure out how much money they're making, but you also really brought out the amount of risks that they're taking and how they're managing that. Did anything strike you this year?
Well, yeah, one question I asked the panel is, are you preparing for a long war? And the thing that really struck me is everyone basically said yes. They said, we've been preparing for a long war since day one, and that's our job. It's kind of our job to be pessimistic. But you really do see in the actions that they are preparing for prolonged disruption. One other thing that struck me is they're also going to do quite well out of this period of volatility. That's the trading houses had record profits in 2022, 2023, and they're well positioned to benefit financially from the crisis, even while the executives also say they hope it certainly ends soon. But I think that scenario of the long war, to me, and from talking to people here this week, feels like the mood in the room is that we are in for a long war and certainly for a protracted disruption.
Halima Croft, Managing Director and the Head of Global Commodity Strategy and MENA Research at RBC Capital Markets.
I think the scale of the disruption is so large. I actually got to interview Fatih Birol last week because it was the IMF World Bank meetings. And that was a kind of moment in Washington where there wasn't a lot of optimism. There was a lot of realism because people were having to think about, what does this crisis mean for emerging markets? What does it mean for emerging market Asia? And how do we put the genie back in the bottle? How do we basically try to get flows being normalized? And when Fatih Birol kept saying 13 million barrels are off the market by their estimates, and that during the crises of the 70s, we were talking about 5 million barrels. So the scale of this is so vast that I think for many people, it's just too large to process. So they say this has to end soon.
That's the part that's amazing to me, that psychological aspect of it's just too big to think about, so we're not going to think about it. And I think one of the ways I believe you were trying to put it in context in the panel is the amount of supply we've lost is comparable to the amount of demand that was lost during COVID.
Right. And remember in COVID, it took a while for people to say, wow, this is going to be a multi-month, potentially like multi-year crisis. But remember, the early days, everyone thought it was going to be over in a couple of weeks. But I think what is really different is that during COVID, you didn't have such a relentless messaging machine from the White House. The White House was saying at times, it'll be fine, go to church, but they were also really working on the vaccine. They were working on warp speed to try to come up with a cure. The challenge right now is that you do have negotiations proceeding, but you still have this relentless machine of messages saying we're making so much progress, and the negotiations seem to lag the message.
And there are a number of folks on your panel also talking about this difference between, you can look at the price of Brent, whatever, $95.
Right.
But if you look at products, crude oils in Asia, other parts of the world, $150, $200. How much of that is these details of freight and insurance and
100%.
what's driving it?
Again, this is such a complicated situation because it's a multi-dimension crisis. But we just look at the screen and say, well, we can look at the WTI price that pops up on my Bloomberg or the Brent price. And like that is the sort of mechanism by which we assess the degree of disruption. Whereas, it's a massive product story, also a massive fertilizer story. I mean, there are multiple dimensions of this crisis that in order to get anything back to February 27th levels, it's going to be a Herculean task.
And so I need to ask you about the geopolitics of it all, because I think you stressed the point that there's a feeling out there that nobody wants this to go badly, and the president will just be able to figure it out.
He'll figure it out. And again, throughout this crisis, people say, well, he can taco. And they compare it to tariffs. And I say, well, it takes two to taco in this case. And there are actually multiple stakeholders beyond two, but clearly you need the Iranians on board. But we act like it's single decision maker dynamics, that President Trump can call time, and that is going to be what it takes to bring this to a conclusion. But the problem is, A, we have yet to find, as I said, the Iranian Delcy Rodriguez. We are now dealing, by all accounts, with a Iranian Revolutionary Guard that is more hardline, more doctrinaire, younger. I think one of the best analysis said that you thought you were getting Delcy Rodriguez, you're getting Kim Jong-un, like you're getting North Korea now in terms of the IRGC leadership. So they may not be amenable to taking the terms that President Trump wants to offer, even if potentially the foreign minister of Iran would sign off on that. Then you have other actors in the region. Where do the Israelis land on this? Are they going to be held back? Do the Israelis want the right to periodically go into Iran and do strikes similar to what they do in terms of Lebanon? That's not something that the Iranians want to happen. And so do you potentially have that be what breaks the deal? You have the Gulf states saying pretty vocally, I mean, Dr. Sultan Al-Jaber, ADNOC's CEO, he's now on Twitter. He's been very clear that this conflict cannot end with a Tehran toll booth. So the question is, how do you get all the relevant stakeholders to say, okay, this is the term sheet that we agree to?
And we were fortunate enough to have you talk with us at the very beginning of all this. And I remember the time you said time is on Iran's side, not the US's side.
Right.
So how does that play into this?
Well, I think there's this idea that, again, everyone thinks that they're sitting across. They believe that the Iranians are themselves, like in the intelligence community, it's called mirroring, that you believe that the person on the other side of the table shares your worldview. And so I think there's this idea that like the Iranians, their economy is in trouble. They faced protests earlier in the year, that they are desperate for a deal. But are they desperate for a deal? They still have significant stockpiles of short-range missiles. They still have enough sophisticated drones to be able to continue attacks on neighboring states. They still have small boats that can be laden with explosives and, put in the waters in the region. Do they really feel right now they have to take any deal that Washington puts in front of them? So that's why they continue to say, we can talk about enrichment levels, we can talk about potential suspension of enrichment, but we are not giving up our fundamental right to enrich uranium. So there are these red lines that they still say they're not going to cross.
Robert Friedland, executive co-chairman at Ivanhoe Mines and co-founder, chairman, and CEO of iPulse.
P.T. Barnum said that if you want to get somebody to understand something, you should tell them what you're going to tell them, and then tell them, and then tell them what you told them, and it might sink in. But the problem is that the supply chain is just a mystical concept to people that live in an urban environment, and they just don't get it. And suddenly we're in a situation where we might have to pay a lot more for hydrocarbon, and sort of a global shock. And nobody understands the tertiary implications. Opening soon at a theater near you. And you have all these freaked out traders here. They look like, when I was on that stage and I'm looking at the traders, they all look like deer caught in the headlights. Because they know volatility is coming. They just don't know in what direction. Huh? They're trading, right? And you could get a Truth Social tweet coming over the tape at any second, and it could wipe you out. Good, better, and different. Now, we're miners, so it's a little different. Now, I'm just imagining what it'd be like to be a trader, but you must have nerves of steel, I suppose. Miners are in a different position because we're cooking a meal that we set up 10, 20 years ago. There's not much we can do about it. We certainly don't want to run out of diesel fuel, right? Because you hate shutting the mine down. Your miners don't like that. The host government doesn't like that.
Is that a serious threat right now?
Of course. A lot of remote mines in the world generate their electricity by burning diesel. No diesel, no electricity. You need uninterruptible power 24 hours a day to run a mine. So many remote mines all over the world are burning diesel to operate. And, we're calculating the impact on cash costs with every increase per penny in the liter of diesel. But it's not so much the price, it's the availability. Because if metals prices rise because more mines are closing, let's say 10% of the copper mines in the world close, then we get a jump in the copper price. We can afford to pay more, but it's the availability because it may be diverted to the military before it goes to civilian applications. There's fewer and fewer places where we're allowed to mine. We need better and better technology. We have to find a better way to do it. The numbers are very, very daunting. The numbers are quite mind-blowing. We've used 700 million metric tons of copper to get here today. And we could get it back by tearing down every building in the world and restoring the status quo ante to 10,000 years ago when we were hunting woolly mammoths. Now we're going to use another 700 million metric tons at current consumption in the next 18 years. So we have to mine as much copper in the next 18 years as we mined in the last 10,000 years to maintain 3% global GDP growth. Now that's without electric cars and data centers.
And one of these chains that you brought up in your keynote was on sulfur, which is something that most people don't think about.
It's the king of chemicals.
Can you explain a little bit of some of the uses?
No, like nobody thinks about sulfuric acid. They don't even know what it is. You see, this is why suddenly everybody's going to get a very rapid education in everything. So H2SO4 primarily comes from the desulfurization of sulfur-bearing natural gas. Like in Alberta, Canada, they pull the sulfur out of the gas. It ends up in a big yellow pile of sulfur on Vancouver Harbor. By the way, all of that's now going to the Congo to try to keep the mines running. You have to transport the sulfur, and then you have to convert it back into sulfuric acid. And when we built our copper smelter in Africa, we assumed $150 a ton as a byproduct that we could sell it for $150 a ton. Now, we calculated that number by buying the yellow sulfur in Alberta, bringing it by ship, adding water, and ass backwards calculating that at 150 we'll break even. But today it's 700, 800, 900 a ton and going up. Can't buy that stuff. It's already been sold over there. And so the pump won't work because the vandals took the handle. Now that gets me back to Bob Dylan. Before his name was Bob Dylan, it was Bob Zimmerman. And when he started out as a folk singer. And his first great rap song was Subterranean Homesick Blues. You should play it. There are two great lines in that song. One is, the pump won't work because the vandals took the handle. That's the last line in the song. And he's referring to the supply chain. Remember, they used to have a pump, and you had to pump the water? The vandals took the handle, then you couldn't get any water. And the other one was, you don't need a weatherman to know the way the wind blows. Very quickly, people get the idea that, well, maybe life is more fragile than I thought. So push is coming to shove, and people are realizing that there are vulnerabilities and resource-related issues. And then our markets have to be smarter to send the right price signals if you believe in the magic of the marketplace to dig our way out of this hole. That's why I think Smarter Markets really is related to ABAX, and I think ABAX is extremely important. That's why I was involved in it from the beginning, is that it's very important to have quick, accurate, and realistic price signals. It's very important, no bullshit.
Brian Manell, CEO and chairman at TechMet. So a whole lot has happened in your world since the last time we talked here at Lausanne. I was wondering if you just kind of bring us up to speed with what you're seeing in the critical mineral space right now.
We're seeing an escalation of everything we were seeing last year with respect to focus of attention on critical mineral supply chain security in the US and increasingly in Europe and elsewhere, both in two ways. One is counter China and better understanding and focusing on action to balance China's overwhelmingly dominant control, and also increasingly focus on the fundamental inefficiencies of scalability of the supply of our metals, and therefore structural short supply medium term with or without China, right, or worse without China. And that's a factor that radically complicates what we need to do to transform our industry. And it's not just driven, as it has been over the last few years, by perceptions of growth and demand from batteries, electric vehicles, renewable energy systems. It's been added to by increasing focus on growth and demand driven by manufacturing of defense systems, and obviously AI data centers, the energy infrastructure associated with AI data centers, and something that we haven't yet had adequate analysis and focus on is the critical minerals requirements for the technologies that will accelerate out of the next phase of AI, like humanoid robotics and autonomous driving and autonomous drone systems, all of which are very critical minerals intensive.
And recently, there's been a much more increased focus in Washington, D.C. on the critical mineral situation. What sort of movement do you see there? And what do you think we need to see if we're going to try to catch up to what China's done?
We certainly need to have what is now being proposed happen. So we do need US and other non-Chinese government engagement in the critical mineral supply chain on an order of magnitude that's unprecedented in history if we are going to move the dial with respect to balancing China's position and ensuring adequate supply to feed industry and industrial growth and competitiveness and jobs in the US and Europe and elsewhere. And therefore, all of these programs to de-risk and support non-Chinese critical mineral supply chain initiatives need to be executed and need to be bigger and need to be quicker. And that's the challenge. There's the commitment to do big things and new things in order to achieve these imperatives. The capacity in the system to execute and deliver and deploy capital to actually build projects and produce what we need to produce is all as lags. And there's a lot of willingness and a lot of intent and a lot of determination to unblock the blockages and execute quickly on a large scale, but it has a lot of challenges.
And for people who aren't familiar with that, the mining space, as you are, to do something quickly, are we talking years or decades?
That is the challenge. To transform the critical mineral supply chain as we must involves capital-intensive long-term projects that often take years, not months, to develop to production. And therefore, there are no magic bullet quick fixes, but that doesn't mean we should throw up our hands and say that China's won and there's nothing we can do about it, because every day and every month we can make a difference. And that's what we're doing as TechMed across our 10 operating companies.
And you're good enough to sit down with us on day one of the Commodities Summit. Curious, what do you think the conversation is going to be, and what types of conversations would you like to be having here, given how much is going on in the world right now?
Again, I don't think there's anything new. It's just become more urgent and more pressing and more obvious what we have to do in order to mobilize the right financing and the right support and the right partnerships to totally transform the supply chain of these critical minerals that we need to be delivered in a manner that is not controlled by China, that's clean and responsible and scalable. So I don't think there's anything new. It's just the situation in Iran and the markets in general just simply add to the focus of attention on the imperatives and the scale of the challenges and opportunities, of which there are many.
And you're going to be speaking on a panel in a couple of hours. What are you looking forward to discussing on the panel?
Critical mineral supply chain security landscape is one that is so rapidly changing, so important, so challenging, that all the debate and all the ways in which we can add to the level of understanding and analysis and focus are ones that are extremely important for us to participate in.
Gracelyn Bhaskaran, Founding Director, the Critical Mineral Security Program at the Center for Strategic and International Studies.
It's funny, if 5, 10 years ago, traders kind of were their corner little gathering of the world. But what you start to see is a stronger government presence. We had multiple people from the US government here. We have miners here. You have capital markets here. And I think a lot of that is realizing that if we don't get the flow of minerals right, every part of the economy can come to a standstill. And we saw that last year. So we stopped thinking about minerals in a little bit of a vacuum that traders move around and more of a end-to-end supply chain.
And what do you think traders, policymakers, what do they need to understand about this space to be able to understand each other and to help us move forward in a better way?
The common through line between these two groups of people is actually, how do you make these supply chains economic, right? People are only going to mine these things and move these materials if they're going to make money. And the question is, what is the delta between the current state of the world, whether it's logistics costs, ports, rail, whether it's prices being low because of market manipulation from a bad actor, whether it is a shortage of certain materials. The question is, how do we make it economic? And that's where these discussions are really, really important, right? Because often with a little bit of support, like a bridge to bankability notion, right, these projects can run, the materials can move, and you can create more resilient supply chains.
I'd love to dive into the bridge to bankability. What do you think governments can be doing to help make the investments on the mining, production, distribution side more bankable and get more of the investment that we're going to need?
So there's like two sets of policy challenges we can look at, right? One is stability. So in this particularly, a lot of our traders here are going to be looking at Africa, Latin America, Asia, where you see a lot of policy change. If they don't feel confident that the framework in terms of export controls, in terms of the tax framework, in terms of beneficial ownership is going to stay constant, then it's really hard to make an investment that could be anywhere from 50 to 100 plus years, right? Mines run for a very long time. The second set of challenges we look at is actually things like offtake, price stability, concessional financing, because historically capital markets haven't actually moved very effectively when it comes to minerals. And a lot of that, our U.S. Interior Secretary, Doug Burgum, he said recently, mining is like a very unprofitable hedge fund, right? And part of that is like in the US, it's 29 years to get a mine off the ground. So your money can sit for 29 years, or you can go put it in a tech ETF and you know where you're going to make money. So a lot of that is going to come back down to, how do we ensure that these processes, these permits are moving faster? And that's going to be really crucial to get these investments going.
Of course, there's a lot of conversation about the conflict in Iran right now. How do you see that affecting the critical minerals space?
Look, logistical corridors are a huge part of minerals, right? At the end of the day, the way minerals move often from where they come out of to where they are processed is not over land, because often they have to move continents. And so in that vein, when we think about what resilient supply chains look like, a huge part of the consideration is, are there reliable logistical options? Is there a plan B option to get material from two places? The second part of it is Project Vault, this economic security stockpile. The materials have to be held in the United States. So they can come from anywhere, even China, but they have to be held in the US. And part of the reason is if you did have a logistical disruption, we still need to ensure that we can access those materials, or it's not very useful.
And given China's dominance in the space right now, and that it will take us a long time to catch up, how do you think we need to be thinking politically about the relationship with China and the scope for collaboration?
It's a very complex question as someone who sits in Washington, I have to say. Look, the reality is right now we are kind of at a bit of there's been a cool down in the temperature of the relationship, right? Is there a world where close collaboration is likely? Hard to tell, because China is still looking at Taiwan and we're also looking at Taiwan. It's also coming up to a midterm election in the US, another presidential election. So, if I could predict the future of the world, I'd be a lot wealthier than I am today. I think the reality is we are still deeply dependent on China. But, I think the real question is this. Look, you can't go to an African country and say China is bad and America is good. They don't buy that. But what I think most people in the world agree on is that diversified supply chains is healthy. Having all of your supply in one country's hands is a massive economic and security risk. So it's not about necessarily saying China has to be zero, but it's saying that economic diversification is a really healthy thing for everyone.
Ruth Kroll, CEO of the London Bullion Market Association. You're speaking on a panel this afternoon on gold. And I was curious, what do you want to tell people about the gold market right now?
Well, I'm delighted that gold has been included in this event. It feels to me as an oversight. I would say that. I also would say that a lot of people have been coming up to me as gold having a moment. I actually think it's a new chapter. And the reason I say that is that I think within the industry, we knew the value of gold as part of a diverse portfolio, as a reserve asset. But I think the world is waking up to that should be a more mainstream part of a portfolio. It's nothing on the fringe. And it can actually bring a lot of safe haven during these uncertain times that we live in. So I think they're a little bit slow, but I'm delighted to see gold's included, and hopefully it'll be a feature for the future.
And there have been quite a few wake-up calls for gold over the past year. A lot of the conversation at the conference right now is, of course, on the conflict in Iran and the impact that's having on many commodities markets. What impact do you see that having on gold right now?
Well, I think it makes it more in demand. I think when we saw the disruption that happened with the outbreak of the war, you saw gold playing its role exactly as it should. It's a point of liquidity. It's a winner that you can sell to cover the losers. And so you saw it perform very similarly to US Treasuries on that point, and a rebound in the price that came after that. So I think, yes, it's going to continue to be of interest as we have so much uncertainty. Certainly that's been the conversation I've heard today. And I think for the world that might be very optimistic, if we look a little bit more cynical, when the strait opens, it's not as if we just go back to early February straight away. There's a lot to unwind there.
So it's a new chapter in many areas.
Yes.
And when you look at another theme of the conference has been the shifting of supply chains in a way that's very new. Do you see that happening in gold as well?
I think to some part, but it's still a smaller aspect. I think the focus on the region has really meant that there's been disrupt to airlines and also metal flows, whether into the region or passing through as a hub. I think it's something the industry has dealt with in recent years. I think COVID was quite a challenge when it came to moving gold around the world. It normally goes by passenger aircraft. So COVID was much more challenging from a supply chain. So I think there's been some rerouting, but I don't think it's anything the industry can't overcome. I think what is important when it comes to supply chain is the traceability side of things.
And you've been doing a lot of work on the traceability side and a lot of work at the LBMA over the last few years of getting the gold market ready for its next chapter. What do you think the gold market needs to be ready to be more mainstream in people's portfolios?
I think the main work we've done over the last 10 years is bringing that transparency. And that's not just on supply chain, it's also in terms of data. We went from one of the most opaque markets to one of the most transparent. And what that's brought is that as the world looks to gold, it's having a moment. It's actually saying, well, here's some data we can get into and say, look at the case, look at how it's performed in these various crises that we've had over the last 6 years, and decide for yourself whether you're a prudential regulator looking to recognize gold as a high quality liquid asset, or if you're more like the folks who are here today, you're a big commodities trading house who has looked at the base side of things, but precious has perhaps been in the too difficult box. Start to say, well, we should absolutely be part of this market.
And on the supply chain tracing and the understanding the provenance, what are the most important aspects that people want to know about the provenance of the gold that they're buying?
I think ultimately it comes down to what we refer to as a chain of integrity. You want to know who you're doing business with and where that material is coming from. And that was always done on a more paperwork and in-person understanding the individuals, but actually having technology arms around that allows you to scale up and to operate with confidence. I think it's wonderful that you have so many new entrants, but they do need to make sure they equip themselves with the standards and the processes so they don't inadvertently fall in with illicit actors or get taken advantage of in parts of the world. Because it is a global market, and one with the price moving as it is, you need to be careful.
And what are some of the most interesting initiatives you're working on now at the LBMA?
Well, I think the traceability piece is important. It's really going from confidence in gold that is unknown in terms of provenance to known, and something that here in Switzerland, I would say the market is very passionate about and is a bit ahead of other parts of the world of really wanting to know which mine has this come from, How can I look through that kind of life story of the material and have confidence, not just in the material, but also the entities that you are dealing with?
And before I let you go, I wanted to ask, as a conference participant, anything interesting that you've heard in the conference so far? Anything surprising that you're going to take away?
Well, I really found the opening comments about the they asked the panel what they've been surprised about, and that the optimism was very interesting to me. And actually, I think that's right. I think as humans, we tend to be very optimistic that the world is going to get better. And it's really recognizing that we have seen energy shocks before, but this isn't something that we suddenly go back to where we were in January, because there's been talk, yes, it can improve, but there's all sorts of points about supply that has to be unwound. So it's certainly given me food for thought. I think I remain optimistic, but I think that is the point of having gold in your portfolio, is that it's anti-cyclical. When times are bad, gold is performing very well. And so it's an important thing to have in these uncertain times.
And Alistair Weir, Head of Environmental Markets at Abex Exchange. Well, the conference just wrapped up, so I thought it'd be a good chance for us to catch up. I'm curious, you've been out in the hallways. What's some of the interesting conversations you've been hearing this year?
So I think everybody expected this to be a fascinating conference, right? Given all the geopolitical implications of what's gone on in the Gulf and the ramifications for commodities markets. I think even ahead of what kicked off in the Middle East, the ramp up in volatility in gold and silver has meant that we've had a fascinating time, both as an industry and broadly as an exchange. So lots of fascinating conversations to be had around risk management, managing volatility, and kind of working out what the trends are in the industry as a whole.
And I found it, speaking of trends in the industry, it was kind of fascinating this year to me, even with the agenda of the conference. Still a lot of conversation around oil, conversation around LNG, a lot of conversation on metals, less conversation on carbon this year relative to previous years. And I really enjoyed, there was a good power panel the other day, and really thinking about how the whole energy market is evolving, becoming more power-oriented, more gas-focused, more carbon emissions and metals. And how are you seeing that conversation about the products that people are interested in right now?
So you're absolutely right. If I think over the last couple of years, predominantly the conversation has been really around energy transition, right? I think environmental markets have had a front row seat in that conversation. What we've seen more recently is a focus to energy security, right? So countries are thinking much more around kind of protecting their domestic economy, moving from kind of a just-in-time type mindset to a just-in-case mindset. And that's meant a kind of deep reflection as to kind of what the energy mix looks like. In Europe, I think that's a lot more renewables, that's a lot more nuclear. In Asia, maybe that's a pivot back to coal in certain scenarios with a lot more nuclear. And so we've seen the shift in conversation, which I think is kind of fascinating to watch play out in real time. From an exchange perspective, I think it provides all sorts of new opportunities. Obviously, we've made a big push into weather and kind of power adjacent markets in Europe. I think that will continue to spread into other markets. Obviously, the US is becoming an increasingly big focus for us, but also in Southeast Asia. It really is kind of fascinating to see that kind of immediate shift in mindset.
And I'm curious, you mentioned the weather markets. You're launching a German solar contract shortly. What's been the response on the weather side, and what's really driving the interest?
So I think commercially, we've been pleasantly surprised by the interest from the market, whether that's utilities trying to manage their own risk, hedge funds that are looking at from a perspective, or merchants that are increasingly getting active, sitting between, let's say, those risk takers and risk makers. And so I think, look, obviously we're launching our German solar product tomorrow. We expect this market to grow pretty substantially over the coming years. Obviously, nothing that's new gets immediate liquidity, but I think we're very confident in the way this market's evolving. I think one of the most interesting lines that at least I heard today is some of the Asian funds are now trading the kind of wind gas arb. And we look at it historically as, let's call it, a domestic arb between, let's say, German power and gas. But people are extrapolating that out, and you're having them trade Mongolian wind versus German gas. And I think that maybe is partly led by kind of the increase in computational power and kind of modeling through AI. But possibilities in terms of trading and interesting ops is just continuing to grow.
Mongolia to Germany. That's fascinating. One of the themes of this conference was seeking advantage in a fragmented world, and really this focus on the supply chains and almost like a redrawing of the commodity map. Curious how you've seen people responding to these threats to supply chains like we've seen in Iran, and also just a world where the connections are different than they used to be.
I think we can look back to 2022, 2023 as the first kind of major geopolitical transition, right? Obviously, the Russian gas impact on Europe was pronounced. That made particularly this part of the world kind of wake up and pay attention as to kind of what the ramifications are from their energy supply. And over the last few years, both politicians and the private sector have been thinking through how they prepare for the next event. Well, we're now in that next event. And a lot of thought and effort's gone into how do they prepare for it. Right, we've just come out of the CFO panel, and obviously the CFO spent a great deal of time talking about how they manage IM and liquidity in 2022 and 2023. I think they were probably having a lot more sleepless nights than they were this time around. They all seem much better prepared. That being said, there's still, I think, a lot of change that's due to happen. And turning around an economy the size of Europe's is not an easy thing to do overnight. It's going to take months and years for the European Union to kind of properly rebalance its energy supply.
And before you go, I wanted to ask you, obviously we're always interested in building smarter markets and all the hallway conversations and the panels that you've listened to. Curious if there's been any sense of what the market participants are looking for next or where they see their big commercial needs.
I think the CEO of Trafigura put it best, Richard Holtham, in terms of them being a shock absorber for the world's economy. In periods of volatility, these guys really go to work. I would like to think as an exchange that's helping these traders manage risk, we'll be right there alongside them. I think volatility is expected to remain pretty pronounced for the foreseeable future, and consequently the kind of tools that the market needs will continue to evolve. We've just got to be creative and nimble alongside the needs of the traders and the broader economy.
Thanks again to all of our guests and to the FT for partnering with us at their Commodities Global Summit 2026 in Lausanne, Switzerland. We hope you enjoyed the episode. If you would like to listen to the full interviews, they're available on our website, smartermarkets.media, on the SmarterMarkets Presents media page. They're also available on our second podcast channel, SmarterMarkets Presents, available on all major podcast platforms. We'll be back next Saturday morning with our regularly scheduled podcast. We hope you'll join us.
This episode is brought to you in part by Abax Exchange, bringing better price discovery and risk management tools to navigate today's commodities markets through centrally cleared, physically deliverable futures contracts in energy, environmental, battery materials, and precious metals markets. Smarter Markets are here. Contact sales at abax.exchange to get started. That concludes this week's episode of Smarter Markets by Abax. For episode transcripts and additional episode information, including research, editorial, and video content, please visit smartermarkets.media. Please help more people discover the podcast by leaving a review on Apple Podcast, Spotify, YouTube, or your favorite podcast platform. Smarter Markets is presented for informational and entertainment purposes only. The information presented on Smarter Markets should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on Smarter Markets are those of the participants and do not necessarily reflect those of the show's hosts or producer. Smarter Markets, its hosts, guests, employees, and producer, Abax Technologies, shall not be held liable for losses resulting from investment decisions based on informational viewpoints presented on Smarter Markets. Thank you for listening, and please join us again next week.